Here comes our fourth learning objective, that is evaluate collectability using the allowances for uncollectible account, which is very important. So a company gets on account receivable only when it sells the product on credit. So ideally the company would collect cash for its receivable, right? But companies rarely collect all of their account receivable 100%. So the smart managers, they you know keep account for uncollectible accounts, or they forecast from the collectibles that 5%, 2%, 10% of the account receivable they are not collectible due to some reason. The customer bankrupt, or they're going to be a fraud, they're going to be like deceiver, right? So there are benefits of selling on credit as well. So let's talk about first the benefits and the cost of selling as well. So benefits are customer can buy on credit, and what happens, sale increase and profit increase. But when we talk about the cost, is that you may lose the money because you cannot get the money back from the customer. You already sent the goods, right? So we record it as uncollectible expense. So smart managers, they make an allowance in advance. They predict that okay, 1% or 2% or 5% or 10% or whatsoever are not recoverable. If you know it is recovered, then we have meet our expectations, more than an expectation. But the reason is, or you may ask the question, why we make a reserve or allowance for uncollectible. So it is very recommended, or nice for the smart manager to predict any kind of risk in advance, so that your cash inflow and outflow is stable and you can plan your financial decisions better, right? So if you recall our cash budget, in which we talk about the cash financing, or if we talk about all the payments of interest and all the stuff, this is all based on cash collection from customers, cash collection from, right? And after cash collection of customers, then we base our analysis on the basis of payment to suppliers, salaries, and budgeting for purchasing and assets, blah blah blah. If on the first step we did not realize that, or our first step in cash budget is not according to our expectation, because we are not making an allowance for uncollectibles, then the whole cash budget may affect adversely. So that's why the smart managers, they make allowances in advance for their uncollectibles. So this is the reason. So allowance method, the best way to measure uncollectible expense is by the allowance method, right? So this method basically records losses based on company's collectible experience, right? So from the company experience, we know that 2% they are bad debts, or bad customers, or they are not recoverable, right? Then you record uncollectible account expense, or that is the actual one you charge it to income statement. Those who did not pay, they are expense, who charge it to the income statement. These are bad debts, or bad account receivables, or just uncollectible account receivable. So we set up allowance for uncollectible accounts, which is contra account, or the opposite account of account receivable, right? If account receivable increase, we call this debit, but if allowance for account receivable increase, it is credited, right? So just I'm going to give you a hint. So all the reserves and allowances you can treat it like increase in allowances, credit, always like credit, right? Balance sheet, how the allowance methods record the account receivable is like that. We have account receivable less allowance for uncollectible debts 25, and we write it down here the full value after minus from account receivable, right? So in that way, so just gonna tell you one thing, did you see this kind of transaction before? Yes, when we talk about the depreciation in our previous chapters, when we talk about that, it's a contra account, accumulated depreciation is a contra account, right? But this is the current assets. We will learn the account for depreciation in our coming lectures, in which we also talk about the contra account. So here this is contra account. It means contra account is always showed after the account. That is, if the contra account for account receivable, it will be showed or represented right after account receivable. But these two would be opposite, right? So here, so this is the alternate presentation. We can also write it down as this one, account receivable net of 25 allowance. Either you can write it down minus allowance, or you can just write it down in a statement form. So two basic way to estimate the uncollectibles. One is percentage of sale method, and one is aging of receivable method. So percentage of sale method is basically income statement approach. As the name suggests, sales is a part of income statement, so this is income statement approach. Aging of receivable method, receivable is a part of balance sheet, so this is a balance sheet approach, right? So let's talk about first the percentage of sales method. So simple, 1% of sale, 1% of, if sale is 1 million, then it is 100,000, 10,000, right? Simple. So we have an example here. So June, it is September 29. The Apple Incorporation accounts have these balances: account receivable and allowances like this. Suppose the Apple credit department estimate that uncollectible expenses are or is 0.005 of total revenue, or we can say that 1% of total revenue. So which are 1% of total revenue is revenue is 156,508 million. So the entry that records uncollectible expense for the year would be like this. So if we talk about the percent of sales method, we have to multiply 1% with that one. So uncollectible will be 78 million, right? Because this figure is in million, so this figure is also in million. So what would be the entry then? The entry would be that uncollectible expense which we charge to the income statement to allowance for uncollectible, right? So basically we are forecasting that this may, it's all in million, so 78 million worth of dollar may be lost due to customer not paying that, right? So but this is a suspicion, so that's why we create an allowance. So all my suspicion is my expense go to income statement, this allowance just go to balance sheet, right? Question may occur that what if this not happen? If this not happen, then we make an opposite entry to make sure that we our forecasting was wrong, right? We will deal with later. So let's move further. So how we gonna adjust that one? We increase our allowance. If we just post this entry into a ledger, it will like that. So expense account, we create it, it's a debit, it's 78, right? Nothing happened to accounts receivable. Why? Because we created a contra account. Everything happened to the allowances for uncollectible debt or uncollectible accounts.